Hey, if you're looking to create a set of financial projections for a therapy or psychologist clinic or practice, and you've come to the right place because we have built a financial projection template built specifically for this type of business model. So if you're a therapist or a psychologist and looking to open your own clinic, and maybe you need an SBA loan or you're trying to raise some investment from outside investors and they've asked for financial projections, that's what this template is going to help you work through. I'm going to take you through it step by step. I'm going to put a link in the description of the video below so you can grab the template and follow along. Also, if you stick around to the very end of the video, as a thank you for sticking around and watching a video about spreadsheets, we are going to give you access to a coupon code, a discount code, to be able to take a discount on this particular template. Before I dive into the details of the template, just a little bit of background on me. My name's Adam Huxema. I'm the co-founder of ProjectionHub, and I spent 12 years as the executive director of an SBA lender. We made about 1,500 SBA loans during my time there, and then more recently have transitioned to my own business here, ProjectionHub, and really focus on helping clients that are looking to raise capital. A lot of times it is from an SBA loan, but it wouldn't have to be. It could be from investors or other lenders as well, to help them prepare their projections. So that's kind of the background here. And if you go through the video here and you say, you know what, I just really want someone to do this for me. I don't feel confident with numbers or spreadsheets. I just like someone to handle this for me. We do have a service that we can help fill out and customize the model for you. So feel free to reach out to us at support@projectionhub.com if you'd like that help. All right, with that out of the way, let's go ahead and dive into the details of this template. Okay, we're going to start on the at a glance tab here, and after you have filled out all of your assumptions in the model, this is kind of the deliverable. You're going to get a number of charts and graphs that you'll be able to put into a business plan or a pitch deck for investors. You're going to get a 5-year income statement summary, a 5-year cash flow summary, 5-year balance sheet, and then your income statement, cash flow, and balance sheet all broken down by month for each of the 5 years. So you're going to get really everything you're going to need for presenting to an SBA lender. But in order to produce these reports, we have a little bit of work to do. So we're going to go back to our input tabs here. So these blue tabs are the various tabs where we need to input various assumptions about our plans. So the first thing to know is that any cell that's highlighted in blue is an assumption you can change without breaking anything in the model. So we can put in our company name, we can put in our projection start month, and then for this example, we're going to assume this is a startup therapy practice, and we have a personal investment. We're going to invest $20,000. So for this example, we're going to assume this is a startup therapy practice, and we're going to assume that we invest $20,000 in personal investment in month 1 of the business. On the accounts payable side, this is kind of the 80-20 rule. So this is saying that we're going to pay 80% of our monthly expenses in the month that we incur the expense, and then 20% of expenses maybe we put on a credit card, so we incur the expense this month, but we maybe have 30 days to pay the credit card, and so we actually, from a cash flow perspective, we're not going to pay that expense until 30 days later. So we often just keep that 80-20% kind of built in there as a default. Now on the accounts receivable side, we're going to assume our current accounts receivable balance is 0 because we're a startup, and then we're going to assume that the average days to collect payment for providing our service is 30. Now this really depends on whether you're private pay only, a mix of private and billing to insurance. If you're only billing to insurance, for example, it might be that you provide the service, it might take you a week or 2 weeks to actually bill that, and then you might have to wait 30, 45 days. And so this number could be, maybe 60 days, right, between when you provide the service and when you get paid. Or, if you're private pay, you might get paid up front at the time of service. So we put 30 days here. This kind of maybe is a mix. If you're partial private pay, partial insurance, maybe it averages out to 30 days. Now, inventory, you don't really have inventory. You're selling a service, you're not selling products, so we have zeros in here for the inventory section. On the fixed asset section here, so we're going to assume that you're going to lease an office space, maybe do $25,000 worth of kind of renovations and leasehold improvements to get the practice, looking nice. And then maybe you have some equipment, some computers, printers, that sort of thing, $15,000 there, and then some other furniture and fixtures of $10,000. Now, let's say we are looking for a startup loan, maybe an SBA loan of $100,000. We've got an 11% interest rate over a 5-year term or 60-month term here. Now we can move on to our input revenue tab here. So the first thing we need to note here is this patient acquisition section. So what we are assuming here is 0 current patients. Again, this is a startup, so we're going to just set that to 0. Maybe we have an advertising budget of $500 a month. And then what we actually have here is that decreasing over time. So maybe over time, we get more and more of our patients through word of mouth. And so our ad budget actually decreases. We can set a cost to acquire a new patient. Let's say that's $250. So that ad budget really is just going to bring in a couple of new patients from paid ads in the first months here. And then maybe more of your patients come from organic sources or word of mouth. So let's say we've got referrals for 5 patients a month, building up this total new patients here. So we have 7 new patients a month here. And then what this section down here will do is allow us to set a maximum number of patients. So if you're meeting with somebody weekly or every other week, right, your number of patients that you as one provider can see is really going to be relatively limited. And so you might want, like if you want to just model, this is only going to be you're never going to have additional providers in the practice, then you might want to set your maximum number of patients much lower. In this example, we didn't really want to artificially set that bar too low. Maybe you could add additional providers as you grow. We set that to 1,000 for the practice. We said percentage of patients who leave each year is 50%. So basically that means the average patient kind of term or time with you is going to be 2 years on average. And so then that helps us calculate our number of active patients here each month. As we bring in new patients, but then some percentage of our patients leave each month as well, we can kind of build up this number of active patients here. We can set a inflation rate here for prices and increases in material costs. We have our categories of assessment here, or categories of service is assessment and testing and therapy and counseling. So let's say every new patient, the way this works is every new patient is going to have an assessment and test, initial assessment here, $150, and you can change the fee for this if you'd like. We also put in a small material cost. We set that to 2% of revenue. Maybe you have some tools that you use in your therapy process that have some costs associated. And so we wanted to at least consider that in the model here. And then we have this blacked out average services per patient per year here because this is only going to be a one-time service for these initial assessments. But here for a therapy session, ongoing therapy session or counseling sessions, we're going to charge $125. And here we can set the average services per patient per year to, let's say, 20 on average. Now you might have some patients that come weekly, some that come less often, once a month or bi-weekly. And so this is where you want to put in that average number of sessions per year per patient. Here you can see the average percent of fee reimbursed. So, this is the fee you're charging. We're saying that you're going to actually collect 95% of that. So maybe some percentage aren't going to pay, or insurance doesn't pay the full amount for whatever reason. Okay, the rest of this is just calculations then on the revenue side. And so on our expenses, our operating expenses here, we can add things like accounting. We've got insurance billing service. So we have this set as a percentage of revenue here. We can see from the drop down, we can set expenses as a fixed dollar amount or a percentage of revenue. If we set it as a percentage of revenue, we can set it as 0.06 represents 6%. You might hire a third-party service provider that bills insurance on your behalf and they collect a percentage of revenue. You might have rent expense, $2,000 a month for rent expense, other operating expenses here. Okay, let's look at the salaries tab. So for the salaries, what we started with here is we're saying, okay, you as the owner, you are going to have a $70,000 annual minimum salary. So if you want to set yourself to say, hey, I need, this is kind of what I need as a baseline salary, and otherwise I will take the profits above and beyond that base salary. I'll take the profits of the business in addition to that. So this is kind of the minimum salary. And in this example, we said we're actually not going to start the minimum salary till month 13. So again, maybe you can't afford to take that salary as you're just starting out the practice, but by month 13, year 2, you're hoping to be able to take that minimum salary here. So you can also set benefits and employer taxes. You can set an annual raise rate as well. And then let's say here you want to hire an employee, a second provider here, and they're also going to have a annual minimum salary of $70,000, but they're not going to start until month 25 here. So as you build up the practice, you hire additional staffing. And there's a section here that I want to draw to your attention, this variable compensation or bonus section. So what we're saying here is that this new employee starting in month 25 is going to generate 50% of the revenue, 50% of the billable work, and we're assuming that you are going to generate the other 50%. So we could actually probably just put that in here for clarity's sake. So this new employee is going to generate 50%. And what we're saying here is that the employee is going to make a variable compensation where they're going to make 40% of their production after they kind of meet this minimum salary. So basically whatever number is higher. So if their production for a month, or let's take it for the year. For the year, let's say their production for the year was only $100,000 in revenue. 40% of $100,000 is only $40,000, right? So they're going to make $70,000 minimum salary. So they're going to make their minimum salary still. But if their production for the year was $200,000, 40% of that is $80,000, right? And so they would actually, in that case, once their 50% of the total revenue gets to $200,000 in this case, they're going to start making the variable compensation instead of the minimum salary. So hopefully that makes some sense. There's a little bit of flexibility there in how you want to kind of, model out paying providers as you bring on additional staff. All right, so here is administrative staff, maybe a front desk or billing or customer support type person at the front desk, that type of thing. Maybe we don't hire that person until month 6 in the practice. We only have one of these employees and offer a 3% annual raise. Okay, so that is really it. That brings us back to our at a glance. And we can see in the first year, we just break 6 figures. We have a small net income of $13,000. Now in the second year, we're up to $230,000, but your net income doesn't go up all that much. And the reason why, the thing you need to remember here, or at least one of the reasons, is that this operating expense now in year 2 is going to include your paying yourself $70,000 a year, right? Your compensation as the owner of the practice is the salary that you're paying yourself plus the net income or the profit of the business as well. Okay, so that is it. Thank you for watching till the very end. So as I promised, we have put a link in the description of the video below to a form that you can fill out and get a discount on this particular template as our thank you to you for watching to the end. And if you found this video to be helpful, we'd love it if you subscribe to the channel and like the video. That would really help us as we are trying to produce more content that's helpful to small business owners and entrepreneurs that are looking to start businesses and need help with projections and business plans and maybe seeking SBA loans. So if that was helpful to you, we'd love it if you supported the channel. If you have any questions at all or would like our help filling the template out, reach out to us at support@projectionhub.com and we'll be happy to help. Thanks.